Good morning, ladies and gentlemen, and welcome to today's webinar, Real-Time Daily Trading Ideas. Today's April the 8th, and just like every day of the week, I am speaking to you from our office in the heart of Berlin. Today we will be speaking about trading ideas, strategies, market screenings, and we'll be answering your questions. Before we can start with the actual webinar, we will briefly present the risk disclaimer. Trading with financial instruments offered by Medrow markets carries a high level of risk, which is not suitable for all investors due to its complex nature. Please make yourself familiar with these instruments by using a demo account if you are a starter. Please feel free to contact us if you need any assistance with that. Please also note that none of this is investment advice. The statements made in this webinar only represent the personal opinion of our traders. You can also find the whole risk disclaimer on our website. Here you can see the schedule for the week. Today it's Jay's turn. And before I finish off with the introduction, I would like to invite everyone interested in trading to try us out and benefit from the best index and forex offerings with spreads of just 0.8 pips. Just like every Monday of the week, Jay is going to be the speaker for today. Trade smart, live free, that's his motto. Let's see what piece of valuable information he has in store for us today. I'm passing over the screen to you right now. But good morning, Jay.
Hey, good morning to you. Give me 1 second. 1 second. 1 second. 75.35. I didn't finish the trade, so we'll have to do it together. No worries, we'll do it together. We will do it together. There was so much news, and I was at a funeral over the weekend that I wasn't able to finish the slides in time. Not to worry, we'll get it all sorted. Sound okay?
Sound okay.
Sound is okay. All right, great, excellent. That's the wrong slide. Perfect. Perfect, of course, being sarcastic. Okay. Let's see. Why is it saying this slide? Give me a second. Possible trade opportunity. Okay, got it. All right. Good morning, guys. Hope you had a good weekend. Now I'm ready and to go. Sorry for the delay. Trade last week, shorting New Zealand versus Canadian dollar. Recall that the New Zealand, the RBNZ, Central Bank of New Zealand, shifted dovishly on March 27. And that was a surprise to the market, which means a lot of the institutional funds are caught on the wrong side, i.e. not short enough, and that then causes a reshifting of allocation and sustained weakness in the New Zealand dollar. And on the Canadian dollar, I expected a little bit better than forecast employment numbers. Unfortunately, that didn't come to fruition. Nevertheless, and that's the problem with this webinar on a Monday morning, would be much better to do it on a Tuesday morning, because then you can see the flows on Monday where everybody gets into position for the campaigns of the week. And we were looking to short at 91.36, and I actually saw that we're not getting there, so I was ahead of the curve. I was early. I shorted a bit earlier, so if you didn't get into the market, if you don't know how to read the market yet, then you may have missed this trade. Was a solid winner for a lot of my traders and myself at plus 63.5 pips. Anywho, on to this week. What do we have on the headlines? We have Asian equities trading mixed. Was a sluggish session. The Nikkei was off 20 basis points. Australia was up 65 basis points. Hang Seng was up 35, while Shanghai was lower by 10 basis points. Oil traded very strong, started this week with Brent and WTI near their highest since November of 18. Libya's civil conflict was intensifying. Obviously, that's Libya's civil conflict is intensifying. Unfortunately, that is one factor supporting oil. Then we had positive news out of OPEC Plus and Russia. They're all adhering to their self-administered supply cuts. We have WTI and Brent futures contracts all in backwardation, even though we do have a strong dollar, so there's a lot of demand in the market right now. And then on Friday, we had solid non-farm payroll numbers, which supports the notion of the market, which the market is currently playing, that we are seeing a global recovery in terms of economic growth and trade by Q2 and Q3. Obviously, the determining factor there is the US-China trade war. We're getting one deadline after another being pushed out. Maybe we'll get a photo op in the near-term future that there's some kind of resolution. The sticky point right now is access of US companies to the Chinese markets, and that's why they're holding off on a common declaration or announcement of such. And then additionally, we're also seeing additional sanctions on some of the ships by PDVSA. So oil market very strong this morning as well. Saudi Aramco bond deal is coming. Demand already touted above $30 billion, so pricing is either expected on Tuesday or latest on Wednesday. That bond deal is going great. Congrats to all the investment banks involved in that deal. The fees will be horrendous. IMF is seeing Australia's housing market contracting, leaving the economy in a delicate situation. So even the IMF is having an eye on the housing market, as do we. And we are especially interested in shorting Australian banks with weak loan books when it comes to future non-performing loans once the housing market bubble starts to burst, which it will. They always do, and this is much, much larger than the one in the US back in 07-08. IMF report on global downside risks to the housing prices. Canada risks have increased, and my team and I, we are additionally having an eye on Switzerland because there too, the watchdog is stating that we're seeing risks to the housing market. Also in Switzerland, I don't know if you guys saw that news over the weekend, I forgot to put it on here, that the watchdog is looking to having the largest Swiss banks increasing their funding buffer by an additional 28 billion. Amazing. So there'll be an additional capital requirement put onto the large banks. If you're long Swiss bank stocks, be careful, they might come off on the back of that news. Non-farm Friday, we had the so-called Goldilocks scenario, i.e. employment numbers, as expected, solid and up, but wage pressures subdued. We call that Goldilocks, where you see economic expansion, but not runaway inflation. Probability of a Fed rate cut this morning at 53.9% for 2019. After the non-farm payroll numbers, that probability shot up briefly to above 75% or touching 75% because the average hourly earnings came in much weaker than expected, i.e. less inflation in the pipe, i.e. less need for the Fed to hike rates. Weekend data on surging Chinese gold reserves. March buying of 11.5 tons of gold. So the Chinese central bank is continuing their buying spree in gold, as are other central banks around the globe. ETF funds are showing us that investments in gold ETFs are actually coming off, i.e. reduced a little bit. Nevertheless, gold playing the weak dollar this morning, rising. I've been long gold for about a week now, once again, off of bottom edges. Had to be careful, had to be patient, hence I played it via a bull call spread in the money. Anyway, Italy is expected to raise its 2020 budget deficit goal this week. That's going to cause some more discussions with the EU once more, and we keep a keen eye on Italy and the Italian-German government spread as a leading indicator if and when we get stress in the EU once more, which we will. Brexit, Friday, April the 12th is the current exit date. I am super, super eager to see how long the extension will be. Okay, UK May request a May, obviously that's Prime Minister May, capital M, sorry for that guys, is requesting a June 30th extension and could offer a customs union compromise to the Labour Party, according to BBC Radio. Sorry, another typo in there. Tusk is looking to seek approval for his up to 1 year extension for the Brits, which would give them and add some flexibility once they come up with their deal to then let them out earlier. The funny part will be if the UK will have to participate in the EU votes coming up. It's amazing. Volatility actually came off in the 1-month risk reversals, so the market is getting a little bit more relaxed. At least the market makers on the options side are, and are not expecting a breakout this week. We'll have to see, because the pound-dollar, i.e. cable, is trading in a tight range. Some analysts are touting this week could yield the breakout of that box. I'm not that sure of it. My co-instructor is looking at long pound. I'm looking at short pound. Obviously, I would look to short the pound if there was a hard Brexit, and then just add to the position on the short side if and when there's an uptick. Every tiny little uptick, I would add to it. But I do see the long as well. If we get an extension, the problem with the long is I think it's going to be a weak long, a weaker long, i.e. a sluggish long position, because the businesses in the UK are really suffering under the uncertainty in terms of their investment decisions, and trade is being hampered by the prolonging of this Brexit and debacle, I call it. Last but not least, we have the semiconductor ETF on the radar. Why? Because it is the most sensible and sensitive, not sensible, excuse me, the most sensitive ETF to the US-China trade talks. We used to look at beans on the commodity side. Now we're here on the equity side. We're looking at semiconductors, and as you can see, they're at 1-year highs or breaking through 1-year highs. That looks like a breakout that's valid and to be continued. So aspects of the market, some smart parts of the market are expecting an actual sort of positive breakthrough when it comes to US and China trade talks, which then, of course, on the Forex side would be positive for the Australian dollar, for example. Okay, strength versus weakness. In the Asian session, we saw some mixed risk picture. We saw some strength in the pound and some strength in the Japanese yen. And we did see some weakness in the commodity currencies with the Aussie, the Kiwi, and the Canadian dollar, while the US dollar was trading range bound. Week ahead, we have the euro and the central bank. On Wednesday, we have the central bank rate decision expected to remain unchanged at 0%, and we have a presser, i.e. a press conference. Ahead of the meeting, we were able to observe an increase in communication about what's called a tiered deposit rate system. That would be put in place to mitigate the negative side effects for banks in the Eurozone for the zero interest rate policy or the negative interest rate policy. As you may recall, the deposits of banks with the central bank are being punished by negative 40 basis points, i.e. the banks have to pay a fee, a negative fee, for holding cash reserves with the central bank. Now, the ECB knows that the zero and negative interest rate policy causes a flat yield curve, which makes it extremely difficult for banks to make money, because banks borrow short-term and lend long-term on a flat yield curve. That mechanism is hampered, and the fees and the possible fees that can be made are actually reduced. So the ECB is looking to help the banks by potentially paying them back some of the cash that it collects from its negative interest rate charge on excess liquidity that the banks are depositing with it. That's one aspect of the potential policy. If this policy is installed, it could signal to the market a money market policy of lower rates for longers and even potential future rate cuts. That would be quite negative for the euro initially. The market also is looking for more details on the announced TLTRO3 program. Again, another program to help European banks get their funding in place on a cheaper basis than if they were to go to the normal capital markets. So funding at very cheap rates to increase the loan books. The idea continues to be, hey, if we help the banks push out more loans, then that could help the economy. Recall that Western economies, when we talk about economic growth, what we're really talking about is credit growth. So if we have credit growth in the market, then that is equivalent to economic growth. My personal current opinion is that we're going towards the Japanification of the EU, i.e. No rates, zero rates, flat yield curve, no growth, horrible scenario. Focus will be on the ECB's view about economic growth in 2019. As you can see here, since April 18, economic growth as measured by the manufacturing PMI has been coming off, and manufacturing is still a very large part and an important part of the German economy, and the numbers have been very weak recently. Lastly, the market is looking at the ECB's inflation outlook. Has their inflation outlook been delayed, i.e. Slightly below 2% inflation, or does it need to be adjusted lower? Interesting note here, based on positioning data, traders cut long euro positions last week by the biggest margin in the last 9 months. And obviously EU bond yields, especially German bond yields, went negative on worsening purchasing managers indices. So here we see euro inflation hovering around 1.4, 1.5% over the last 4 readings, and it's going to be important to see if that's going to pick up again. That would be positive for the euro, but we're not seeing that quite now, right now. Okay, on the Fed side, on Wednesday we have the FOMC meeting minutes. Recall that in March, the Fed kept the rates unchanged at 2.25 to 2.5 corridor. The bank sees no hikes in 2019. That's interesting, and 1 hike in 2020. Currently, market is pricing in a 54% probability for 1 rate cut in 2019. Yes, you read that correctly, a rate cut. So the question on your mind should be, why is the Dixie trading up here if the market is pricing in a rate cut? And that's very good. It has to do with what's called the dollar smile. Rest of the world economic growth is coming off, means funds are flowing into the US to invest in US equities, US bonds, US real estate, you name it. It's all going there. And trust me, over the last 10 years, there has been so much cash created by the central banks, it needs a home. In addition, last night on talk radio, I heard a statistic which I unfortunately forget. I need to read things. I don't know how your brain works. I need to see things. My brain is not very good at listening. It's good at reading. Other brains work well by listening to stuff. So I forgot the statistic, but it was something crazy like every other day there's a new billionaire made in the global markets. So all that money needs to go somewhere. And currently it prefers the US. But that may change if we're playing a change in the global economic growth scenario. Fed's neutral rate estimated at 2.8% and seeing weaker near-term economic growth and tamer inflation conditions when compared to December. And it was interesting because Powell during the meeting said that he sees that currently rates are in the range of neutral right now. So 2.8% versus now 2.25, 2.5. So we're two hikes apart from what Powell is stating right now versus where the dot plots are seeing a neutral rate at 2.8. New York Fed nowcast, that is in a dynamic number right now, is seeing Q1 2018 GDP at 1.4. We were at 0.6. Then we're slowly ticking up as new economic data is becoming available, currently at 1.4. But then recall that in the second quarter, we're already expecting to be coming in around 2% again. If we do see 2% economic growth for a sustained basis, expect equities in the US to go up by roughly 5% per year. That's the model. That's what the market is playing. Fed will slow the balance sheet runoff beginning in May, ending in September, reducing the cap on monthly redemptions to 15 yards. 1 billion, the institutional traders call 1 billion a yard. Previously it was 30 yards, and then reinvest mortgage-backed security coupons into treasury holdings starting in October. And they're looking to shift the duration of their portfolio shorter. So for a lot of the new guys are like, what the heck is this guy talking about? Sorry guys. You have entered the world of professional trading, and that's actually relevant. So you need to start, just like learning a foreign language, you need to start learning the words first, and Google helps you there. DeepL, very good translation software. The balance sheet size will be approximately 70% of GDP, around 3.5 trillion versus 25% of GDP at the peak in 2014. Now, the Fed intended to reduce the balance sheet much further, but the economic development is hindering them, and that's why they're looking to stop the balance sheet reduction, sorry. And then on Wednesday, we'll also have CPI numbers, very important inflation gauge. It's expected to come in 1.8 on a year-on-year basis and not 3 increase on a month-on-month basis for March. Previously, it was 1.5 and not 2. So if it does come in strong like that, expect some further gains in the US dollar. Interestingly enough, Nomura, my old shop, they're expecting lower numbers due to vehicle sales and then prices for clothing. We'll see. We'll see. The dollar is trading in a box right now, in a range, 97, 97.5. Possible trade opportunity for this week. It's really not easy to find one, and it has less. What I teach my traders is this, guys. I teach them, if and when you want to put money at risk, give the trade or the investment a rating from 0 to 10. And my traders are not allowed to take trades with a rating below a 7. I wouldn't necessarily rate this trade a 7. I would rate it like a 6, okay? So I'll take it in the portfolio, so we'll have it tracking. But last week, the New Zealand dollar trade, that was New Zealand CAD, that to me was a 9, okay? That's why I entered it very, very early on Monday morning. I did not want to miss it under no circumstances. So last week was a 9, this week was a 6. If you've never heard of rating your trades, start doing it and start digging into it. It helps you a lot in terms of learning about yourself and your behavior. Because not every week offers good opportunities, and not every opportunity is a good one, okay? Some opportunities are really worse. So I'm looking to long Canadian dollar versus the Swiss franc. Now you see, Jay, last Friday, the numbers were horrible for the Canadian dollar. I know, but the numbers for the US economy were great, and the correlation between both economies is very high. So my expectation is for the second quarter and third quarter economic numbers in Canada to come in better again. Labor market is in good shape. We had one bad reading, and it is not going to hinder the central bank. One reading is not changing the central bank's policy path. And while the central bank is positioned data dependent and neutral, it still, until recently, had a hawkish tilt to it, okay? So that's what I'm playing. I'm looking for the Canadian dollar based on Q2 and Q3 sentiment being positive in terms of economic growth, and especially very strong oil prices, so I need to keep an keen eye on oil. If oil continues to break out to the north side, it could be finally the week where the Canadian dollar strength comes back into play, especially since the US dollar is expected to trade a little bit weaker this week. So on the Swiss side, the SNB was very adamant about their willingness to intervene. We don't have any major tier 1 data really this week. We only had on the Swiss side Tuesday unemployment rate, and we do know that the employment market situation is solid in Switzerland. Also, in terms of risk on, risk off, currently the market seems to be favoring the yen in terms of a risk off currency. That's why I'm happy to be shorting the Swiss franc here during this week. The rest of the trade are obviously weak housing data in Canada, and housing data is coming on Monday, i.e. today, building permits on a month-by-month basis, expected to come in better. And then we do have house price index on Thursday. That's a little less relevant. Today is a little bit more relevant. So maybe during the New York Open, we'll see the Canadian dollar weakness as they're manipulating lower. We'll have to see. Yeah, so, and that's why I said I didn't really finish the slide, unfortunately. That slide is still wrong. I'd like to long at 74.75. So that's very close to where we are trading currently. My take profit would be 75.35. So if I calculate that correctly, that's 60 pips. And then we need to put the stop loss around 74.97. Sorry, 74.75 minus 30 basis points is 74.45, so 74.43. 74.43, and that gives me a risk to reward of 2 to 1. Okay? All right, excellent. Let me put that trade into the system next. I hope it was value adding for you. We appreciate you coming in on a Monday morning. Thank you very much for doing that. Thanks to my traders for supporting this. Thanks to Admiral Markets for the opportunity. Let me check the clock. I can't see it. I don't know how long we did it today. Thanks, guys. Marcus, good to see you. Hope you're better. Sorry. And yeah, these are my guys. Thanks very much. Let's see if there's any. Pound just plummeted 600 pips. Thank you, Darshan. I see you every week in here as well. I appreciate you coming in. Let's look at the pound real quick. That's interesting. What happened there? What happened there? Pound futures. I can't really show the screen right now. Well, the futures is still at 130.94, so 131. So, and interest rates are diverging currently. So no clear signal at the moment. Excellent. Guys, thank you very much for coming in. Hope to see you again next Monday. Let's make some pips. Little less volatility expected except for the pound. So if you are very firm at what you're doing and you know what you're doing, enjoy trading the ups and downs of the pound this week with a real-time swap. Thanks, guys. See you next Monday and have a wonderful week. Thanks for coming in. Bye-bye.
Thanks for the comprehensive analysis.